Is earnings season this time around going to help propel this next leg of the rally or be a cause for concern for traders and investors?
That's such a great question, and it's always difficult to come into an earnings season at all-time highs because that reaction function to negative news or a miss is going to be much more exaggerated than we typically see in your average earnings seasons if we look back over the last 3 quarters. So my guess is we're going to probably see punishment for the companies that miss be a little more extreme than we've seen in the past. And I think as we work our way through this week, which is largely the large cap financials, we'll start to feel a little bit better about the entirety of the S&P 500. We get about 120 companies reporting next week, so to give us a much better view in other sectors other than just the big large cap financials.
Our expectations, it's fair to say, have been tempered over the course of the past few weeks and arguably the past few months. We are not expecting any kind of market earnings growth this time around. In fact, for the second half of the year even, we are expecting perhaps some earnings declines. So take us through the expectations game. Is this a market that can rally if those expectations, albeit lowered, are now exceeded?
Yeah, so 3 things to think about in terms of expectations. First and foremost, we have very difficult comps every quarter this year. So north of 20% earnings in 2018 is the quarters we're comping against. The second quarter was 24.6% last year. So that's very difficult to beat. We're probably going to be in the low single-digit earnings growth for the front half of this year. That's what the first quarter looked like. And if we have that historic beat rate, which just means we usually have 68% of companies beat, they usually beat by between 3 and 5%. So we'll be in low single-digit earnings growth, which is okay for where we are right now. I think in terms of what makes this better and what makes people feel better about both the market and the economy is somehow getting the U.S.-China trade tensions behind us, because I think that's what's holding everything back.
All right, so let's go into that, because earlier, just yesterday, we got data showing that the Chinese economy is growing at the slowest pace in 27 years.
Right.
But some of the more high-frequency data showing that industrial output is pretty decent. We have some pretty decent numbers coming out about retail spending and the consumer there. All in all, is the China trade war now going to be an issue as much as it was, knowing that China's economy is perhaps not as bad as some had feared?
Yeah, that doesn't make it better in terms of shortening the time frame of getting this accomplished, right? Our biggest concern is how long this lasts. The elongation of the U.S.-China trade tensions is what's manifesting itself in slower economic activity, both domestically and globally. We don't like to have either side start to all of a sudden feel emboldened, right? So what makes that happen? All-time highs in the market, Fed cutting rates in July. On the U.S. side, emboldens our side. On the Chinese side, yeah, 27-year low in economic growth, but better than expected. And oh, by the way, because of the fact that there's a massive amount of government stimulus going into that economy driving that there. But we'd like to get this over with sooner rather than later.
Before we let you go, it's a big Fed meeting this month. Do they cut? Do they not? Is it 25 basis points? Is it 50?
Yeah, they're going to cut. I think it's impossible now to walk back the expectations that they've given the market. 2 days up on Capitol Hill, commentary throughout, and pretty consensus that it's 25. I think the real question now is this the beginning of a pattern of cuts, or is this a one and done to take back December and get to where they really think neutral is?